What is going on, guys? Welcome to our Finance Tuesdays. I hope you're doing really well. And in today's video, I want to talk about the difference between high yield savings accounts versus whole life insurance and why I prefer to stick my money in whole life insurance versus keeping it in the bank. Now, as of today, high yield savings accounts are earning 3 to 5%, which I think is solid. I'm not going to lie, that's a good rate. But obviously, when you put it in these types of accounts, it does vary. So it's not guaranteed in the future you're going to earn 3 to 5% if you stick it in this type of account. That being said, you have to wonder, how are they getting those profits? Where are they getting that money from? Well, there are four quadrants when it comes to banking. You have your depositors, which is us, where we deposit money into the bank. The second one is banking, where they take your money and they borrow it to go out and invest. The third way is the borrower. So we borrow, whether it's credit card, get out a loan, right, or a secure line of credit. The fourth way is shareholders. That's where the bank earns their profits. Now, what if you could be all four of those, where you are the depositor, you're putting money in, you're the banker, you're taking money out to borrow, and your money's still growing at the same time? Because when you take money out of the bank, you can't use that money again. It's gone forever. Once you make your purchase, whatever it may be, that money is back at zero. You see, when it comes to whole life insurance, when I stick my money in there, well, what's going to happen is, one, when I take money out, that money is still there and it's still going to grow. I'm still going to earn my dividends. I'm still going to get profits, right? Another thing is, if I keep my money in the bank and it grows at a specific amount, well, let's say the bank goes insolvent. If you're in a situation where the bank is no longer solvent, but they're going to take your money to get solvent again because they've been taking risk with your money. That's why it could be a challenge to keep your money there, because if you end up in a situation where the bank is no longer solvent and they need money, where they can't rely on the FDIC because they don't have enough money there to keep them solvent. So they go to the consumer they've been working with and they take their money instead to get them back in a better financial situation. And that's not good, right? Because you rather have your money in a place where it's safe, where it's going to keep growing. And if you want to use that money again in the future, that opportunity is available. And the cool part about whole life insurance is you have that opportunity in front of you. So when you borrow, you use it to either pay off your debt, invest in either passive income, or invest in education. I think those are three good things to use it for. When you pay yourself back, well, what you're doing there is you're restoring your capital and you're able to use that same money you once borrowed. That's what the banks do. They take your money, they go out and invest, and they do it all over again. So if you act like the bank here, you're going to end up in a good spot because, one, you're saving consistently. You're still doing that, right? You're still earning on an annual basis. I know 3 to 5% might not be a lot, but it's still growing. You get guaranteed growth. You got a death benefit on top of that. That's another perk. So if something does happen to you, you get to leave something to your loved ones. All they got to do is just submit a claim and they get their death benefit. If you have everything, obviously you have to have everything properly designed. But again, this is why I prefer whole life insurance, because my money is not only going to grow, but I know where the money's going, right? When it comes to banks, I don't know what they're doing with my money. As soon as the deposit hits, they're already investing it. And that can be tricky because, obviously you have no idea what's going on. But I'm not saying you shouldn't use a bank. I think it's good to have a bank in case an emergency happens, or obviously day-to-day expenses. That's understandable. But when it comes to just saving or investing, I don't trust the banks. I just don't, because they're going to take my money and do something I might not like. So again, put it somewhere where it's safe, where it's going to grow. And if something does happen to you, your family's protected, the money is secure, and you can use your purchasing power in the future as well. Because, again, when you pay yourself back, you got that capital again. Again, when you take it away from the bank, you no longer have that opportunity. It's always good to know what is going on with your money than being blindsided. So again, if you're earning your 3 to 5% and you don't want to listen to this, that's fine. This video is not for you. But if you want to be in a situation where you have more control, where you want to see your money grow, then this will definitely help you out. I've been using life insurance for the past 4 years. I'm getting ready to open up a second policy in the next 3 months. So I'm excited about that. And the reason why I'm doing this is because I want to make sure my money is protected and it's still growing and I'm still earning. That's what's important. And I have control over it. When you're in a situation where the bank has control, you have no idea what's going on. You don't know where they're investing it, where they're putting it. And that could be a difficult situation to deal with, especially if they misuse it, an investment goes wrong. And we've seen situations like that before. Hope you guys enjoyed this video today. I'd love to hear your thoughts on, what you think about high yield savings accounts versus whole life insurance. Don't forget to like and subscribe to the channel, and I'll see you in the next one.